Hi, my name is Tiago, and I'm here just to give you a bit of overview what we think is going to happen in 2023 for structured products. But before we go to what is going to happen in the next years, I think we need to take a step back for the last 2 years. So when COVID hit, equity markets fell considerably. We had losses from a lot of the banks that were trying to hedge dividends, but that didn't stop the growth of the market. In places like the US, in places like Europe, there was a lot of growth from private bank clients, wealth, institutionals, looking at structured products as a way to get yield back to 2 years ago. Now, last year was a bit more difficult because you also had a bear market. It was not only equity, but also fixed income, where returns were really, really low. Structured products also suffered from that. Taking into account the total outstanding of structured products, there wasn't really products expiring early or calling, which means that there was less volume. So what we hear from Asia is that the market was down 50% last year. In Europe was down around 10%. In the US, it just grew by 4%, but only because of what happened with Barclays and Barclays' rescission process of almost $15 billion. So, taking that into account and looking at this year, we started the year very well. I mean, January, if I look at the market, mostly in Europe, was up 4% compared with last year. US, it was clearly down around 10%. And we can see that this year, it seems that it's slightly better. I mean, the current outstanding products are above their initial strike levels. So I think we see that the rollover speed is increasing, even, not January, but February. And now in March, we see a big increase, even with the current last 2 weeks performance. So we can see some positive aspects. So, the rollover speed, but also and the current levels of the products, but also the high volatility of the last weeks also benefits structured products, as of course inflation is still high. Now, on the negative, there are some important things to think about. One, which we already mentioned a couple of weeks ago, with Silicon Valley Bank bankrupt and then expanding to Credit Suisse and being acquired by UBS. There is a massive impact, especially on the hedging of the structured products risk by investment banks. We estimate that there was a loss in the last 2 weeks of $1.5 billion in investment banks' P&L. I mean, it's shared for more than 81 issuers of structured products, but the big banks who had a very good last 2 years also had considerable losses. Okay, and of course is also the change of interest rates. Last year they were quite high. Now we see the Fed, the ECB highlighting that they will stop due to the last weeks. I think we see that also as a negative. So we kind of see some positives with some negatives, and I think what we'll see in the next few months is an increase on structured products, but with potential high risk for a slowdown, especially when the investment banks who had considerable losses this month are going to cut budgets, being less competitive on prices. I think that will impact this year.